Good morning from London. I'm Kriti Gupta alongside Lizzy and Tom Mackenzie. We're an hour away from the opening trade. Here's what you need to know. Help for Hollywood. Donald Trump planning a 100% levy on foreign films while also saying he's willing to lower U.S. tariffs amid ongoing bilateral negotiations. And more price pressure. OPEC Plus agrees to its second consecutive monthly increase of oil production, further roiling a market already dampened by growth concerns. And the Oracle of Omaha passes the baton. Warren Buffett stepping down from the helm of Berkshire Hathaway, leaving behind a record cash pile at one of the world's largest companies. Lizzy.
Good morning, Kriti. Happy Monday, everybody. It is, of course, a holiday here in the UK and in Japan, but we have got futures here for the rest of Europe and the US taking a bit of a breather after the S&P notched its longest winning streak in more than 2 decades last week, boosted by the trade talks. And now we have progress on trade talks with Asian nations other than China, boosting some of the FX currencies in that space. Look at the Taiwan dollar, absolutely rocketing, up the most since 1988. We shall discuss that as well as these oil moves. Below $60 a barrel, a 4-year low after over the weekend OPEC Plus ramped up production again. The countdown to the opening trade starts right now.
Good morning, everybody. Plenty to digest around the world, from the United States to what's going on in Asia, across the markets. And yet today is, of course, a bank holiday in the UK, so those markets are closed. We are seeing a pound that is stronger this morning at 132. Still plenty to digest as the world perhaps comes to some sort of reckoning with what we're getting out of Washington, D.C. Let's start there, where Donald Trump over the weekend making some interesting comments when it comes to things like trade, maybe not touching Jay Powell for a little bit, although not really impressed with what he's doing over at the Federal Reserve. And in just the last couple of hours, talking about a 100% levy on foreign films. Lizzy, I don't know where to start.
Well, the good news is that he's willing, he says, to lower China tariffs because at some point he realises that what the current tariffs amount to is a trade embargo. So he says he knows that, and he says that you could get other trade deals as soon as this week. The bad news is that he says he's got no current plans to speak to Xi Jinping, and, you know, you've got to ask how substantial those near-term deals with other Asian nations are actually going to be. So, you know, as I say, you're seeing the significant impact on the FX space.
Well, the market disappointment that they're not going to be having a call, the two presidents this week, fundamentally shows that the markets misunderstand how the mechanisms of politics in China work, because simply you would not get a presidential meeting within this time frame without having had the lower levels work through some of the base issues. And so that misalignment is interesting in terms of markets misunderstanding what's happening. What about John Voight, though? Sylvester Stallone, Mel Gibson. Did you know, this is what missed a bit past me, but I didn't notice this in January. They were named as ambassadors to Hollywood. So it's apparently John Voight's recommendation then, or at least part of the recommendation, to alleviate the collapse in production of film and TV. This is a real issue that Trump is latching onto. Whether it's a real solution is a very different question.
Well, California as a whole, so much of their GDP and so much of their revenue comes from Hollywood at its core. It has had the double whammy, or triple whammy, I should say, of the COVID impact, so the delays that are coming in terms of content production. It has the, of course, the writer strikes and the Screen Actors Guild strikes as well. That has really slowed down the production even further. And on top of that, the fires around Hollywood and L.A. as well. So the Hollywood industry, that was this burgeoning kind of gem of California and the United States, has slowed down. Now, not to the extent that it's still not the leader of films internationally, but it's enough to clearly catch Donald Trump's attention. So he is certainly targeting something that's crucial. But remember, a lot of these films, if they don't make the box office in the States, sometimes the budget works in their favor to have this international exposure. So this is where the reciprocal tariffs really matter here. You start to see foreign films maybe put something similar to that. A film could basically not make money in the States and still make their bottom line abroad. This kind of puts that math into contradiction.
Well, you said the word international a couple of times there, and for good reason. For example, just one example of a film that's currently in production that it is international, being produced, for example, in Thailand, the UK here, where we have tax breaks for films, Malta and the US. Jurassic World Rebirth is just one example. Now, talking of dinosaurs, oil, dinosaurs, there's a link there, isn't there? What you dig up out of the ground, the production of oil. Overview, OPEC Plus coming through. Was that too much of a...
No, I loved it. I loved it. I didn't have dinosaurs on my bingo card today, but keep going.
Not a surprise that OPEC Plus has come through with an increase in production. from June. It's the number that has come through, 400,000, and the language as well from OPEC+, particularly the Saudis, that they are determined to keep putting additional barrels on this market at a time, of course, of increased pressure, with Brent below $60 a barrel. And then that ties into one of our corporate stories at the moment, which is BP, which is suffering not just from the low oil price, but, of course, a failure to come through with a strategy that addresses the concerns of investors, including activist investor Elliott, to the point where Shell is now apparently looking potentially at a merger.
You opened the door to one of my favourite Warren Buffett quotes. You only know who's swimming naked when the tide goes out. And yes, we have long had problems at BP with the net zero strategy, but it's the lower oil prices that have really revealed just how difficult things are at BP at the moment, and therefore Shell looking at possibly sweeping in to buy it, as we report over the weekend, but looking how far that share price is going to drop before they actually make their move.
Well, the idea that oil consolidation is coming to Europe, and to your point, long kind of in the cards or on the cards for quite some time in this part of the world. The fact that Shell, and this hasn't been priced in, by the way, this is a Bloomberg scoop over the weekend, has not been priced into the markets just yet. So it's likely to keep an eye on when we have the Amsterdam index open, see how Shell share price reacts. This is important as well because when we're talking about this massive OPEC plus supply that's hitting and these oil prices now that a lot of the corporates have to work with, think about how much this is affecting the states as well, because you are now seeing oil trade below the break-even prices of so many of these corporates, which brings to the question of consolidation, not just in Europe as a function of some of these major big oil, but Chevron, Exxon, over on Friday, they cut back their buybacks. They pulled back on their dividends because of this concern. On the screen, we're seeing some of these break-even rates. 62 is, or 61, I should say, is your lowest level of a break-even of those various key oil shale producing regions. We're at 56 on NYMEX right now. So it is actually unprofitable for Americans to produce oil.
So as Trump heads to the Middle East this week, where is his attention? Is it on the weaker price and a win? Or is it concerns about corporate America when it comes to that oil industry?
Well, you might ask whether his relationship with Mohammed bin Salman, the Crown Prince, is precisely what is pushing Saudi Arabia to agree to push the price lower and boost production in that vein. But I mentioned Warren Buffett. I feel like we have to talk about the Oracle of Omaha, this great announcement, massive news that the world's most famous, if not the greatest investor, is going to be stepping down. Charlie Wells is here with more on that and the other announcements out of Omaha this weekend. Charlie, give us a rundown.
Lizzie, this was such a surprise, even to Greg Abel, apparently himself the successor to Warren Buffett, when it was announced that Warren Buffett would be stepping down as CEO of Berkshire Hathaway at year-end. Now, Abel has enormous shoes to fill to the tune of 5.5 million%. That is the return that Berkshire clocked between 1964 and 2024, so huge shoes to fill there. But Abel has a unique skill set. He joined Berkshire in 2000. He rose through the ranks on the energy side, and he now runs the non-insurance businesses at Berkshire Hathaway. But there are questions as he comes into this position, questions about his stock-picking prowess. We know that is what made Buffett so famous to the investment community. Can he do the same thing? Another question is that $350 billion cash pile that has only been growing over time that investors want Berkshire eventually to deploy.
Yeah, Charlie Wells, we thank you. I read that Berkshire Hathaway's holdings of Treasury bills account for 5% of the outstanding market. So that's the equivalent, if it were a foreign country, of India, Switzerland and Taiwan, bigger than them. You know, this could have massive ramifications, whatever Abel decides to do with this pile of money.
That's an incredible stat, actually, in terms of those Treasury holdings.
Absolutely. I mean, this is the 8th largest company in the world. This is enormous. Outside of TAC, outside of Saudi Aramco, speaking of the oil piece as well, just connecting it to the big theme of the day, of course. He also made some key comments around trade. He said, that trade is ultimately a weapon of war at the end of the day, so not really smiling on some of the policies coming out of the United States right now. He's also, I should say, known to be a value investor, part of that, including some things like oil consolidation and value investments over in the States as well. So I'm curious, as we see more of this oil consolidation story kind of unfold on both sides of the Atlantic, what role will Berkshire play at this, especially when George Abel, who, of course, has an eye on the energy place, is coming to the helm.
He's running the energy business, isn't he? And he's got that cash pile of $350 billion, which is either a benefit or a curse. But within that consolidation story, with that cash pile, to what extent do they expand into that energy space, as you say, Kriti?
But look, he doesn't have Buffett's pedigree. The company said in a previous annual report, if for any reason the services of our key personnel, particularly Mr. Buffett, were to become unavailable, there could be a material adverse effect on our operations. So let's see how that transition happens.
Absolutely. Let's talk about what else we've got coming up on the show. Plenty to discuss. We didn't even get into the economics just yet. Melanie Baker, Royal London Asset Management senior economist, is going to be joining the program. We're going to dive into some of the details, perhaps some of the digestibility of the payrolls report from Friday as well. Robert Dishner, Neuberger Berman, senior portfolio manager, also talking to us a little bit about this bond market. Paris Anand, Artemis CIO, and Bob Long, Stepstone Private Wealth CEO. We've got an all-star lineup this morning, Tom. Excited to dive into those conversations.
OK, so that's today, and that's the show. And thinking about the rest of the week, then, some of the markets for your calendar. Later today, US ISM services data. After, of course, stronger non-farm payrolls, stronger jobs data on Friday. Manufacturing data came in a little stronger than expected as well. So that's later today, and we'll break that for you. On Tuesday, then, the Treasury Secretary, Scott Bessent, testifying on Capitol Hill. Of course, the lens will be on anything he says about trade and tariffs and the deals and any progress there, maybe on Jay Powell as well. And on Wednesday, the Fed rate decision. Talking of Jay Powell, fully expected to hold rates, of course, as he continues to come under pressure from the US president on the rate-cutting outlook for that central bank. And on the earnings front, Novo Nordisk. Those earnings cross, of course, with a focus on the GLPs and those weight loss drugs. Thursday, it is the BOE rate decision. We have Lizzy Burden around the desk, who's the expert on all things BOE, of course. They are expected to cut. And US jobless claims as well, building out the picture on the labour front when it comes to the US. And on Friday, China trade data, which takes us to the trade story. Interesting to hear from President Trump flagging the weakness in the China economy when he was talking about the potential discussions between the two countries and, as you said, Lizzy, flagging that he is prepared at some point to remove those levies. But he's clearly aware and has been informed of the weakness in the Chinese economy, which continues to show itself, whether that's in the export data, the manufacturing data, or the housing market.
I mean, it's fascinating because this is all going to come up likely on the Wednesday Federal Reserve decision, or at least the questionnaire, and not just about where the economics lie and whether the Fed is stuck between a rock and a hard place, as it really feels like it is, but also what is the future for Jay Powell's job. Donald Trump addressing those comments over on Sunday, I believe, to NBC News, basically saying, look, he's not happy, he's not getting an A+ on the report card, but he's also not going to do anything about it until the term ends.
Yeah, and of course we had the payrolls number, as you say, Tom, stronger than expected, and traders cutting their Fed cut bets off the back of that. Not what Donald Trump wants, really. And so the risk is that actually these comments, these threats from Trump about Powell's job dominate the press conference. But, Tom, you mentioned that you've got the BOE decision as well. If you've got the Fed sat on its hands, it's interesting that you've got traders ramping up bets for BOE cuts this year. So fully now pricing 4 cuts from the BOE for the rest of the year. We get new forecasts at this meeting that will take into account Trump's trade war for the first time. And interesting that you've got the likes of Megan Green, who is the hawk, even her saying that Trump's tariffs are going to be disinflationary.
And Trump looks at these other central banks, and it feeds into his ire about the Fed standing put. So as he sees the Bank of England cutting later this week, as expected, as he sees continued cuts from the ECB, which he has mentioned, it fuels his ire. And you have to wonder when his patience runs out, because we know that Lutnick and Bessent are basically curtailing his instincts on the Fed to keep a line on Jay Powell. Does he hold that line until July? Because that is when markets are expecting the next cut to come through. That's a long time in Trump world. A
very long time in Trump world. As Lizzy, you were saying, does the Fed even set the tone for the rest of the central banks? That may not be the case anymore.
Indeed. Well, let's hear what else we need to know about this morning. In Romania, an ultra-nationalist aligned with Donald Trump is through to a presidential runoff against the centrist mayor of Bucharest. George Simion, who is of the Alliance for the Union of Romanians, secured 40% of votes in this weekend's first round, far ahead of the independent Nicusor Dan, who took 21%. A third candidate, backed by the ruling coalition, was eliminated, and so the two are going to go head-to-head in a final election later on this month. In other election news, Australian Prime Minister Anthony Albanese has won a strong mandate to overhaul the nation's economy. His Labour Party returned to power in Saturday's election with an increased majority. Voters rejected the Trump-styled populism of the Conservative opposition, led by Peter Dutton, who was ousted from his own seat in Parliament. Albanese says that he received a phone call from President Trump following the vote, describing the conversation as warm and positive. And plans to modernise the ageing US air traffic control system have gained fresh urgency after vulnerabilities with the existing system pushed United Airlines to cut flights at the second busiest hub serving New York City. This week, Transportation Secretary Sean Duffy is set to release a proposal for a new FAA system to manage the flights that carry about 2.9 million passengers in the US each day.
Certainly one that's putting a lot of that business travel into some hot water, if you will. Coming up on the program, Shell said to be studying the merits of a BP bid. We're going to dive into the details of the Bloomberg scoop and check on the Anglo-Dutch oil merger at the opening bell. Plus, it's a big week for European earnings. Many of the continent's biggest companies giving us glimpses into how they're navigating the current environment. We're going to dive into a full look ahead. But up next, right back into the markets as the latest jobs report shows a solid labor market, which could factor into the Fed's upcoming rate decision. We're going to talk about how investors are digesting the data. If you have any questions of your own for us or for our guests, get involved in the conversation. IB plus BBTV Go is the function on your terminal. This is Bloomberg.
This is a good report all around in terms of demand for labor, supply for labor, and muted earnings growth.
This is a good report, and that's important. You've got more resilience when you're coming to a shock from a place of strength.
The challenge is looking forward. There's a pretty big cliff from an economic perspective heading into the next couple of months. And if we don't get a significant downward shift in the tariff rate from China, then things like the strength in transportation and warehousing is gonna very much shut off.
We have momentum going into a difficult period, and the question just is, will this momentum be strong enough to get us through it?
Analysts reacting to the latest U.S. jobs report showing non-farm payrolls exceeding expectations yet again. So what do we make of it? Is that a good thing or is that a bad thing? Melanie Baker, senior economist over at Royal London Asset Management, joins us around the table. Melanie, pleasure to have you on the program. It's a perfect day to have you here because we're trying to wrap our minds around what this jobs report actually means. When we were expecting perhaps a little bit more weakness coming off of layoffs from Doge, layoffs ahead of the kind of tariff impact as well, and none of that is happening. Do recession calls matter if the jobs market isn't showing these massive layoffs?
I think, first of all, it's just too early to look at the labour market data and feel any kind of confidence on the path ahead. I think your point on Doge, where we did see some jobs cuts was in the federal government sector. It's just elsewhere we really didn't. But, this is April data. Maybe it's just a little too early to expect much of an impact. You saw those GDP figures. You saw how many the sort of front-loading of imports by US companies to try and get ahead of tariffs, the build in inventories. This may just take a little bit longer to play out.
So we're still staring down the barrel of a technical recession. If we get another contraction of growth in the United States this quarter, as we did in the second quarter, is that something this economy can, one, bounce back from very quickly and also just look right through?
Look, I think technical recession in this context, again, you've got to be a little bit careful with it, right? So the reason why the US shrank at all in Q1 was because imports were so strong. Now, if there's a fall in imports, having front-loaded it all in Q2, that could be a little bit supportive for GDP. I think what's important underlying or underneath it all is what's happening to consumer spending, to investment. Those are the kind of things I'm going to be really focused on and really worried about. And at the moment in Q1, those were pretty resilient.
So when does the Fed cut rates? We had a guest on last week who says there'll be no cuts from the Fed this year. Reading your notes, you see maybe even a hike.
Well, I'm just saying I wouldn't rule it out. That's not my central case. So central case is that they will cut, and it'll be more second half and probably around 2 rate cuts from the Fed is a sort of central case. But look, given the amount of uncertainty, I mean, the dust absolutely hasn't settled on tariffs, right? So given the amount of uncertainty, I don't think you could rule out much faster rate cuts than that, and I wouldn't rule out even a rate hike, given we don't know how strong the impact is going to be on inflation and how sort of persistent it's going to be as well.
And what happens when the stool ends up having 3 legs, if it does? Because we keep talking about one stool, the tariffs, but what about tax cuts and deregulation? Where does that all leave the US economy?
Yeah, no, it's interesting, right? I mean, and that's, I guess, part of the reason why I haven't gone too far down this is going to be a US recession route, why I think it's going to be a substantial slowdown, but not a recession. There are absolutely other policy levers in play. And I think what we were afraid of kind of coming into this year was we were going to see the kind of growth negative parts of the Trump agenda before the more growth positive ones. And I feel that's kind of what we're in the middle of right now. And as we go through the year, the markets may start focusing more on the tax cut and deregulation agenda. We'll have to see.
Maybe the pendulum swings back to that pro-business narrative that kicked off the second Trump administration. How does the falling oil price feed in and factor into your views around central banks? With Brent now below $60 a barrel, arguably good news for central bankers who want to get inflation back to target. How are you kind of pricing that in and modelling that through the quarters ahead?
In most economic kind of inflation models, it comes in a sort of fairly mechanical way. It's fairly quick in terms of how it feeds through into inflation, because it quickly feeds through into petrol prices at the pump, and then with a bit of delay into sort of electricity prices, etc. So for this year, it certainly helps central banks ease. It means that when you're thinking about the impact of tariffs in that kind of global trade environment, you're perhaps a bit less worried than you were about that being possibly inflationary, right? So if you've got lower commodity prices alongside things like what's going to happen to all that China trade, how does it get redirected, the kind of downside impact from global growth generally, you're going to be a bit more inclined to think, look, this is probably a disinflationary shock, not an inflationary shock for most economies.
Markets are pricing an endpoint that looks very similar for both the Fed and the BOE by the end of this year, about 3.5% on benchmark rates. But the journey is very different. How far can the BOE diverge from the Fed in the next few quarters?
I think it can diverge a fair way. And we've seen it in the past, right? It's not that unusual to have Bank of England rates at a very different point to the Fed and moving somewhat differently as well. We've been there before. I think for the UK, what's interesting at the moment is I think still a lot of worries about the UK are more domestic than global. It's not really about tariffs. At the moment, it's still a bit more about, look, how are the April tax hikes going to be digested? There's sort of different things in play, I think, for the bank.
Let's bring it back to financial conditions here and just global financial conditions. How much of the massive weakness and deleveraging of the dollar plays a role in some of the unwind and then ultimately the ripple effects into the economy?
Look, it's a fair question. I mean, the dollar's always important, right? And so generally a global financial conditions. But exactly where and when these things are going to end up is very difficult because the policy environment is so uncertain. It would be easy to think about the narrative changing one way and then another over coming months, which would have quite a strong impact, I think, potentially on the dollar and general financial conditions. It's very hard to kind of see where the path is going.
But of course, you've got to factor in euro strength on the flip side of that into the ECB story as you're kind of balancing, on the one hand, the tariff hit to growth, but then the fiscal boost to growth, one the short term, the other the long term. Where does that leave the ECB in the middle when what we know right now is euro strength? Yeah, look, I know. I think from an ECB perspective, I'm still reasonably happy with the forecast that has them cutting further. I increased the amount of cutting I was expecting, given tariffs and partially what we'd seen in the euro. To expect more like 1.75 at the moment for ECB rates this year. But, you know, again, narratives are important to currencies, and those can change as Trump's focus changes over the year.
What would a rapprochement between the US and China on the conversation around trade do to your economic outlook?
That's an interesting question. I guess it effectively, because I haven't forecast global recessions, I haven't forecast US recessions, I'm kind of assuming we do get some rapprochement, right? That tariff rates don't stay where they are at extremely high levels that effectively mean you won't going to get much trade between the two economies. So for me, that would be more of a confirmation of where I think the global economy is heading. So risks there for sure.
OK, Melanie, thank you very much indeed. Coming in bright and early on a bank holiday, of course, here in the UK. Melanie Bacon, senior economist at Royal London Asset Management, giving a good preview as well of the central bank action coming up this week. Talking of which, Fed Chair Jerome Powell's future hangs over a crucial week for these central banks, as we've been discussing. We're going to talk to Robert Dishner, senior portfolio manager at Neuberger Berman, on how to position them around the central bank action. That's coming up. This is Bloomberg.
Welcome back, everyone. We are 30 minutes away from the start of the opening trade. Futures pointing lower stateside this morning after a pretty stonking rally for the S&P, its longest winning streak in more than 20 years. And then here in Europe, we are having a holiday today, a bank holiday for most people in the UK. But for the rest of Europe, we have futures pretty flat across the continent. Flipping over to the bond space, and we're looking at the 2-year bund yield stronger, a basis point at 1.76%. The 10-year yield for bunds weaker, a basis point, but not much happening this morning when it comes to the bond space. Really what we'd like to be looking at are treasuries, but they're not trading in Asian or European hours today because of the holiday. But what we want to know is what the read should be on that jobs report on Friday, as we were just discussing. So let's bring in an expert. We have Robert Dishner, Senior Portfolio Manager for Multi-Sector Fixed Income over at Neuberger Berman. Good to have you back around the table, Robert.
Good to see you.
Donald Trump read the jobs report as saying the labour market's strong, the Fed should cut rates. Bond traders, it seems, had a completely different conclusion. They're saying the Fed doesn't need to cut rates if there's less chance of a recession. What's your read on the US economy?
No, that was the exact read that we had, right? The market had to take out some recessionary risk, right? Recessionary risks, if you look at various things, were up to 60, maybe they pull back to 50 or 45%. So given that people were employed, and in particular the household survey, now there's some question marks about that as well, but that was also a very firm number. So when you combine those two things, and if employment stays firm, the market just has to reprice some of that left tail risk on the recession. So, and that's what they did on Friday, and today they're sort of reevaluating that a little bit. Even though cash futures are closed, or cash treasuries are closed, I think futures are inching up a bit this morning in the U.S. bond market.
So I assume you don't think the Fed is going to cut this week. When do you expect the Fed to cut?
Yeah, so the Fed's got a projections report, so they'll have forecasts on this June, much like the BOE's got forecasts this week. So that might be an opportune time, or if not, in July. And the other thing is June, we'll be getting some data, right, from these port slowdowns, from potential things. I heard one of your guests talk about transportation and warehousing jobs were strong. Was that front-loaded due to all the inventory that was coming in? So June or July looks like the most opportune time for the Fed.
Do you price in, medium to longer term, a higher risk premium for U.S. Treasuries?
You have to. So one of the things that we've been talking about is if the U.S. is successful in reducing its trade deficit, that's less uneconomic buyers of treasuries, right? So just the math of having less foreign buyers due to less recycling of dollars potentially means you need to attract more domestic buyers. Where's that clearing level, right? And, if you have inflation uncertainty, growth uncertainty, those type of things, that puts a little bit of... Now, it's not necessarily oodles of term premium, but there is additional term premium.
And that comes through on the long end of the curve?
Most likely.
What levels are you looking at?
Most likely it comes through at the long end of the curve. But as we approach certain levels, when you see a 5-ish%, maybe 30-year, or those type of things, we've seen buyers step in, particularly in some of the credit markets. We saw that towards mid-month. Once yields got to a certain level, we saw buyers come in those markets.
What is that level?
In terms of treasury?
Yeah, what's the level that people step in at?
Well, people were looking at really yields, when the 30 gets out to that, 485-ish, and then you add a credit spread on top. So if you're talking high fives or sixes for investment grade credit, that starts getting interesting, right, for a lot of players. The other part of it is on treasuries, it's tough to say. Is that 450? Is that 5% on 10s? But certainly that 5-ish on 30s was bringing in some buyers. And the other thing, too, is remember some of these pension funds, when they see these type of rates, that's a really opportune level for them.
So we talk about the bond market and credit spreads so much as leading the rest of this financial system in terms of the stock market, in terms of the dollar, et cetera. What cross-asset signal is the bond market following in terms of just correlations here? So
really three things, one of which is volatility. So if you look at, whether that's the VIX, the MOVE index, or even FX volatility that's following that. The other thing that it's following is the equal weight S&P. So if you compare, the SPW versus the SPX, the SPW underperformed in April. So that's another thing because that's more the broader economy as opposed to the highly concentrated tech SPX.
So those are the numbers that you're looking at. You talked about lots of the data sets that you're looking at. Do you kind of ignore the progress or lack of on trade talks?
Well, trade is tough, right? So we still don't know how to place trade within the context of fiscal packages we're going to be getting in June and July. So while trade might be a growth negative or an inflation higher, and we still don't know the full outcome, what does the fiscal look like in the U.S.? So going back to your point about potential term premium, what does that mean? What does the fiscal look like at the end of all this? How much revenues are coming in from tariffs versus how much is in the tax cut side of things? So it's just a very sort of trading-oriented, volatile time in the Treasury market, but really where we're going nowhere almost. We've been in this like 415 to 450 range, and there seems to be a lot of excitement, but it's really not been that large, to be honest.
When it comes to European sovereign, where are we in that diversification story out of US Treasuries into the European markets? How much further does that have to run?
That's something we're spending a lot of time on in terms of, and it may not be out of U.S. and into Europe. It may just be buying less U.S. and using those proceeds to continue to buy Europe. The other thing is we've talked about last month, if you think about these big sovereign wealth funds, right, that have bought a ton of equities during the zero-rate interest environment, do they FX hedge that or not? Because if the stock market's down 10, 20% and then add a 10% appreciation of your FX, so your fund is then down 15, 20%. Now stocks have recovered, but the currencies have not. So those are some interesting questions for whether that's the Nordisk Bank or the Swiss National Bank or some of those places in terms of what's that FX hedge rate look like. So part of that may be, in an environment where growth is slowing or inflation is slowing, they're not going to do the QE necessarily of buying U.S. assets.
But this is all kind of as we're staring down the barrel of a deficit and this kind of debt ceiling that we're hitting in, I think, July or mid-July is the estimate there. Should Scott Bessent not kick that can down the road? Is that still the trade?
Yeah, you would think that the Treasury will be focused on, okay, how do we fix this and how do we issue? I mean, you look at what the DMO did, what was it, 2 weeks ago here in the UK, in terms of issuing more front end and reducing that gilt issuance. Look, we have one of the things that wasn't necessarily how it is, we have 3s, 10s, and 30s being auctioned this week. And frankly, the past few, I haven't seen this much sort of excitement around auctions in a while, right? And so we'll see what Secretary Bessent says. I mean, he's in front of Congress tomorrow. So I think we'll hopefully get an answer from him on that tomorrow.
Well, speaking of another finance minister, the Japanese one last week was saying, we do hold all these treasuries, but the new bit that he's saying is we wouldn't be afraid to use them. I know when we're talking about Trump, so often it's that we have to take him seriously or maybe also literally. Do you take this threat literally?
Yes and no. I mean, it's true they own treasuries, but would they weaponize those treasuries? It's doubtful. They own enough where they're sort of hurting themselves at the end of the day. But it is a reminder that what happened in April, for example, yields spiked, and that caught the attention of that seemed to catch the attention of the government. And if yields were to rise again, the bond market can be a decent equalizer.
Okay, Robert Dishner, Senior Portfolio Manager for Multi-Sector Fixed Income at Neuberger Berman. We thank you for that look at what's happening in the bond market. We've also seen some pretty wild moves in the oil space over the weekend. That OPEC Plus meeting brought forward. Let's go to Kriti for what caught her eye.
Yeah, Lizzy, the two are not unrelated in terms of the bond market and the oil market, because traditionally, if you looked at 2020, 2021, the two had a very strong correlation. A lot of it has to do with those growth concerns and where that's coming from, how much of the oil price is driving the inflationary outlook. But to me, there's another key piece of this, and this actually is data coming from the Dallas Federal Reserve put together by our producer, Dan Curtis. And I think this is really crucial when we're looking at the break-even rates for American shale. Take a look at this. The break-even, the lowest break-even you have in this region is about $61 a barrel. This is really crucial here because you now have NYMEX trading below. Of course, the U.S. has plenty of refining capacity as well to make up for that kind of profit. But at some point, you do start to see oil become unprofitable to drill when it comes to the United States. And this is a big deal because the United States is, of course, the major exporter, the largest exporter of oil right now in the world. Part of OPEC Plus's strategy, according to analysts, is that in kind of increasing their output, they're also looking to reclaim market share at a temporary kind of hit to their bottom line. Whether or not that sustains is a completely different issue because this is actually a number that affects a lot of the layoffs in the United States. So the ripple effect here, Lizzy, is not just the break-even rate and what it does for oil production, but how much of this translates to a loss of jobs in the States, ultimately an effect in some of the jobs data and the payrolls data, and then perhaps into the Federal Reserve's thinking as well.
Okay, from the oil to the macro, but we're going to switch to the micro next. We thank you, Kriti, because we're going to zoom in on this Shell scoop from Bloomberg over the weekend. We've learned that Shell's studying the potential merits of a BP bid, and we're going to break down the details of that in our stocks to watch. So stay with us. This is Bloomberg.
Welcome back. Happy Monday. We are 16 minutes away from the opening trades this Monday. The focus in the FX space is on Taiwan's dollar, though, surging as much as 5% earlier in the session, the biggest intraday gain in over 3 decades. The central bank said it will hold an emergency press conference later today to address the move. Let's dig a bit deeper then, bringing Bloomberg's Valerie Teitel, who's been flagging this for us since Friday with great excitement, and it's all come round in terms of the focus, with the central bank then expected to update us. Val, talk us through the moves in the Taiwanese dollar and what is underscoring it.
Yeah, less than an hour's time, or excuse me, over an hour's time, we'll be hearing from the Taiwanese central bank on what they're making of this FX move. But this FX move, Tom, is gigantic. It is monster. A near 7% move in the last 2 sessions. The move today, 2.5% stronger in that Taiwanese currency. What is driving this, and why is the central bank not stepping in as they normally would to smooth these market moves? There is some speculation out there, Tom. We know that the Taiwanese are currently negotiating a trade deal with the U.S. Could perhaps a stronger Taiwanese dollar be on the cards in those trade deals? Is that why the central bank isn't stepping in to react? We know that Taiwan has a massive trade surplus, a lot of that dealing with those chip exports like TSMC. They have a large trade surplus with the U.S., and perhaps maybe there's someone in the U.S. administration calling out Taiwan's weak dollar policy as perhaps a non-tariff barrier they wish to get rid of.
Oh, the chip industry. Look, my focus is on what this means for the boba tea drinkers in Taiwan, because they're going to get cheaper drinks as a result of this. The import of tapioca balls from mainland China is going to fall on the stronger Taiwanese dollar. OK, talk to us then about semiconductors, Val. You touched on TSMC. For the exporters of Taiwan, this is challenging.
Yeah, this is not good news for the big exporters. We actually had an update on Friday from TSMC and another chip maker outlining exactly the hit to their operating margins. For every 1 percentage point move in the Taiwanese dollar, their operating margin is shaven off by nearly 0.5 percentage point. So you multiply that by 7. It is not good news for TSMC and those chip makers. That is another question why we're standing around kind of waiting and asking the question why the central bank isn't stepping in to help their local exporters.
Bloomberg's Valerie Teitel walking us through some of those market moves around the Taiwanese dollar. We thank you so much. Let's go to Paul Dobson, our executive editor for Asia Markets, who, of course, is also knee-deep in what's going on with the Taiwanese dollar. Paul, Valerie just walked us through kind of the intrinsic and the dynamics of some of that, what's going on in that currency. How much of it is reflective of the broader Asia FX space?
Yeah, good morning, Kriti. I think that's a really good question. Actually, quite a lot. So what we're really seeing is a bunch of exporters from all across Asia contending with this weaker dollar and suddenly thinking, just a second, all of my my cash that I've been earning recently, I'm keeping in US dollar accounts. Maybe I want to bring it back into my home nation accounts before the dollar goes too much weaker, because I'm losing money on the trade at the moment. And if the dollar is on this longest form depreciation trend, then that's going to be a problem. So it's not just Taiwan dollar, although that's where the most remarkable moves that we've seen have been. Also, the Malaysian ringgit is really on a tear. That also has a similar sort of exposure. Goldman Sachs has been pointing that out in notes. And we did a survey of Chinese exporters not too long ago, and they were also telling us that they were starting to repatriate their funds, which is quite a big change from the policy they've had for several years years where they've been happier keeping it in US dollar accounts where they can earn higher rates of interest. So right across the market, there's that sort of flow which is starting to catalyze some of the bigger moves that we're seeing across the region's currency markets as well.
Of course, you also saw the Hong Kong Monetary Authority buying this record amount of dollars over the weekend. Valerie mentioned, the intervention of the Taiwanese central bank and then the lack of. What do you make of the intervention side of this? We talked about the actual currency moves, but can you spot a pattern? She talked about the possibility for this to be a negotiating ploy in the trade talks.
Yeah, really interesting. So nobody really knows why Taiwan Central Bank has been less interventionist this past few days than is usually the case, where it smooths those moves in currency markets. And it may well be to do with the trade talks. It may well be that this is just a sensitive time and probably being seen to weaken your currency would be undesirable in those moments. But what we are seeing is that the big moves and the dislocations that we're getting across the FX markets are forcing central banks to think at least about what's going on. And for currency that's pegged against the dollar, like the Hong Kong dollar, all of a sudden you've got to start absorbing flows in order to contain those rates as well.
Paul, a collapsing oil price, a tailwind for the nations of Asia that import oil?
Well, absolutely, Tom. And that's sort of going to be mixed up a little bit within the dynamics of the currencies. But for a buyer in Taiwan, for example, this is actually a bit of a double boost because stronger currency gives you more purchasing power as well. On the flip side, in Malaysia, which is an oil-producing nation, less good news because they're losing on both the currency and on the hydrocarbons as well. So it will have mixed effects across the region. But I think interesting and more generally, the weaker crude oil prices should be supportive for the global economy and should be good news. And certainly Donald Trump has been talking that up as a positive. There's just so much else going on at the moment, it's hard to focus on it.
Well, Paul, I can't let you go just yet because I think you said a crucial vantage point, and I'm curious how much stock, speaking of Donald Trump, Asian investors are actually taking in some of these, say, positive or pulled back rhetoric coming out of Washington, D.C. right now.
Yeah, so I think over the past week, there was certainly a great deal of enthusiasm for the idea that the US and China were getting closer to negotiating. I mean, a complete rupture in trade between those two nations is pretty damaging, not just for them, but for the rest of the region as well. It will either ratchet up prices or see dumping of goods from China into various other markets as well. Places like where I am, Singapore, would really much prefer to see the two of them getting along and having trade flows going on in a normal way. So we are very much attuned to everything that is coming out of Washington at the moment, every shift in tone, every nuance within the Trump communications. And of course, a lot of it's happening in our hours as well, at the end of the US trading day into the Asian morning. And that exacerbates those kind of moves, particularly at times when market liquidity is quite thin, which is why we're seeing volatile markets. And, well, if you're a market junkie like we are, Kriti, then it's great fun to watch.
A kindred spirit. Donald Trump, clearly not an early sleeper like some of us are. Bloomberg's Asia Markets Executive Editor Paul Dobson, we thank you so much for walking us through some of the Asian FX moves and the interpretation of Donald Trump's policies. You can get more updated analysis from him and the team. MLIV Go is the function on your terminal. This is a fascinating one. We're continuing to watch the kind of geopolitics that are shaping the markets trade, but a couple of micro movers as well, despite London being closed today.
Yeah, the Bloomberg scoop around the corporates in the energy space, of course, and Shell looking at BP as a potential acquisition target. The stock, BP stock, down about 30% over the last 12 months. It has its own idiosyncratic challenges, as well as the weaker oil price, of course. Some suggesting from this Bloomberg reporting that maybe Shell waits to see maybe a further squeeze in terms of the value of this business, because it trades market cap about 3 times, Shell about 3 times that of BP. But this, of course, would be a sizable and historic deal in the energy space if we get to that point.
Yeah, really fascinating bit of M&A. So we'll watch when Amsterdam opens if we see any movements there. Meanwhile, keeping an eye on Stellantis shares. They've got their Ram brand bringing in a cheaper version of the Michigan-made pickup truck to the US market. So they're trying to boost sales, basically. They're trying to minimise the tariff bill because, of course, they've got to navigate this 25% tariff on imported vehicles and parts. They've kind of lost a bit of market share in the truck segment, which is, by the way, lucrative. But because of higher interest rates, you've had consumers turning to cheaper models when it comes to SUVs. So Stellantis kind of making this effort. Let's see how the stock reacts there. But you're watching Novo, Kriti.
I am. From the car makers to the drug makers, Novo Nordisk, which I believe is reporting earnings on Thursday as well, on Friday after the close, saying the U.S. FDA has accepted its new drug application for the oral version of Wegovy for the treatment of chronic weight management. We should mention this is perhaps the second piece of good news Novo Nordisk has had in the last 7 days or so, after a pretty brutal hit to its stock, about 46%, though. Remember last week, they have also partnered with CVS over in the States in terms of coverage for some of their weight loss drugs, taking a real blow to some of the U.S. makers of the obesity drugs. So Novo Nordisk potentially trading higher.
Yeah,
at the
interesting
open.
that they had, as you say, in quick succession, another win. And
Yeah.
that CVS deal seen as really important and significant for them, overlooking Eli Lilly to take on Novo Nordisk solutions within the weight loss segment. I feel like I'm encroaching on Kriti Gupta's turf here, because Banco Santander in the Spanish banking space, of course, but with an Eastern European angle to this story. Lines dropping in the last 30 minutes or so that Banco Santander has agreed to sell 49% of its Polish unit to Erste Group for about close to 7 billion euros, 6.8 billion euros. That's about 7.7 billion US dollars. One of the largest banking transactions in Europe in recent years, as we look, of course, at consolidation in the banking space, something that Kriti, of course, has focused on. Erste then pulling its buyback plans to fund this acquisition. So Banco Santander, it seems, rethinking some of its exposure to Eastern Europe. Erste taking that on. So we watch Santander, of course, at the open as well.
Yeah, it's a fascinating one. Of course, we know Santander kind of pulling back from some of its European operations. This is a great example of that, leaning into what's going on over in the Americas. A little bit of a contrarian call at this moment when so many other banks are leaning into Europe. Santander going in the other direction. We'll see how that shows up. I'm also seeing a headline here. They're holding an analyst call at 3 p.m. Madrid time. That's 2 p.m. UK on that very Erste sale. So if they perhaps getting a little bit more details on what the math around that looks like. Coming up, it is the opening trade. Futures are relatively unchanged at the moment. Marginal outperformers over in the French index, but you are seeing the U.S. really taking a beating. Futures there down about 0.6%. The U.K. is closed. This is Bloomberg. Another big week ahead of us. So it's only natural to talk about how we ended last week. And this is the chart that really, I think, sets the tone here, which is we ended with green on the screen in both the European and the U.S. indexes. The trajectory is certainly higher. A lot of this has to do with that monster payrolls report. Remember, 177,000, significantly ahead of all of the estimates, really saying that perhaps that economic resilience of the United States not yet dampened by the trade story. Lizzy, we'll see if that holds.
Well, this morning, Kriti, it looks like US futures want to take a bit of a breather. Donald Trump saying that he hasn't got current plans to talk to President Xi Jinping, so maybe that's what's pushing futures down 0.6% on S&P E-minis. And as we look to Europe, pretty flat when it comes to the futures picture. Don't forget, we've got a holiday here in the UK. Maybe we should also be looking over to Amsterdam for a bit of movement, Tom, because we have Shell shares in focus.
Major corporate news. This is a Bloomberg scoop in terms of Shell looking potentially at the acquisition of BP. The market cap of Shell is about 3 times that of BP, of course, which has suffered as a result of its restructuring, or at least its strategy around the shift to renewables and the pressure coming through from investors, activist investors like Elliott. So watch Shell and watch... Well, you can't watch BP because it's not open today, but watch Shell. BP reopens tomorrow on this news that it is assessing a potential takeover of BP. Novo Nordisk, second round of good news then. This is the FDA approving its proposals around an oral weight loss drug. We watch Novo Nordisk at the open. And Santander selling its Polish unit to Erste. Those two banks in focus as well. Kriti.
I mean, it's a fascinating one here as well, because we are really keeping an eye on how those stocks are going to show up. But at the end of the day, the FTSE 100 is closed. It's a bank holiday today, so perhaps a little less volatility, a little less liquidity as well. How is that going to show up in some of these major indices? Of course, waiting for some of them to show up, because as Lizzy said, the futures didn't indicate a ton of movement. Right out of the gates, the IBEX higher by 0.2%. It's an individual movers kind of day that could kind of seep up to the entire index. So I'm curious to see what moves on the inside. The stock 600 down. We'll call it 0.1%. I'm being generous here in terms of volume, in terms of liquidity. You aren't seeing a ton of it. A similar move across the board, but already a pretty decent move to the downside relative to kind of the low volume that we're speaking of. The French index down 0.5%. Lizzy, tell us what's going on underneath the hood.
Well, if you take out the FTSE, because as you say, we're having a bank holiday here in the UK, break it down by sector across Europe, and you've got about half of sectors in positive territory. So healthcare leading the gains, that's at the top of the basket, up 0.3%. Bottom of the basket is energy, down more than 1%. So if we dive into the individual stock story, you mentioned Novo Nordisk, this new drug application for oral Wegovy accepted by the US FDA, and Novo shares up 2.3% off the back of that. I mentioned about Stellantis, this new cheaper version of the pickup truck that they're going to bring to the US market. Stellantis shares up 0.2%. Tom, you flagged Shell. Those shares actually down 1.3% on this scoop of ours that they're looking at buying BP, and hence you've got energy really struggling this morning at the start of opening trade.
Yeah, opening OPEC Plus, of course, coming through with that plan to put an additional 400,000 barrels on the market, which is the macro story that ties in, of course, to the woes of BP and that potential acquisition by Shell. So we continue, of course, to get and await more details on that. That is a Bloomberg scoop, but at a time, of course, of deep pressure on oil prices, with Brent below $60 a barrel at 59.63 right now, WTI at $56 a barrel. So energy is certainly feeling the squeeze, and then you have that corporate story around Shell and BP, which could be one of the biggest mergers in the energy space that we've seen in decades. On the banking space, then, Erste rallying, despite the fact that it's coming through with this plan to buy the Polish unit of Santander. So investors seemingly pleased with this plan. Erste Group up 4.7%. They've had to scrap their buyback to fund this. You have Santander gaining as well. No, in fact, Santander is down 2.8%. So a slightly different picture to the one you may have assumed would come through in the wash on the back of this deal. Again, it's the Polish unit that is the focus of the story when it comes to Erste Group and Santander in that market. So a bit of consolidation in the banking space, Kriti.
Certainly. Well, immediately what caught my eye right at the open is what's going up on the index level, because we are seeing that low volatility. We are seeing that low liquidity right out of the gates. We're seeing the French index take a relative beating. But Lizzy just pointed out to me that you are seeing quite a few ex-dividend stocks, a lot of which are concentrated in France. So she's doing kind of the heavy lifting for me. You named some of them, Lizzy. Danone, however you say it here.
Danone.
Okay.
Beautifully done.
Really beautifully done there.
Someone watched the advert.
Clearly memorized it. AXA, Kering, Hermes, all of them perhaps taking a beating. And I think that's contributing to your point of the drop you are seeing in the French index, whereas you are seeing green on the screen, again, with low volume and low volatility across the board, Tom.
OK, let's bring in our next guest then for a view on these markets. Paris Anand, Chief Investment Officer for Artemis. Paris, thanks for joining us bright and early this Monday morning.
Good morning.
The upside that we've seen in equity markets, both in Europe and the US, is it all going to end in tears?
Well, I think
is it rational?
Well, I think what you're seeing is a kind of a short-term positive reaction as there's a kind of a moderation of the assessment around the kind of the people's worst fears of the kind of Liberation Day impacts. I also think that, you know, there's a little bit of that kind of very short-term sort of risk appetite. But then I think looking further ahead, I would expect there to be, you know, this to not be the end of the story in terms of, like, people will try to ascertain what does this really mean on a medium-term basis, both for the US and for the rest of the world. So I kind of see an environment where actually markets probably consolidate rather than, you know, find a very strong direction one way or the other.
As you look at that consolidation, how are you thinking about adjusting portfolios, particularly on a regional basis? What does consolidation mean in terms of portfolio adjustments then?
Well, I think what you're going to see, you know, not just over the next kind of couple of quarters, but even over the next few years, is a lot of investors really sort of reconsidering the extent to which the indices, the global indices, are actually shaping their regional asset allocation. So we've seen, you know, a really interesting kind of phenomenon, as you well know, which is that US is kind of 70% of global benchmarks, and now people are taking a step back and saying, right, does that really kind of make sense? To what extent have I been led by the benchmarks versus making my own assessment of where kind of value and returns are going to be over the medium term?
Well, yeah, you talked about that short-term risk appetite. There's been this distinction made between, you know, the retail investors who are in there at the moment and the institutional investors who are kind of sat on their hands. Do you get in and, you know, make the most of the rally while it's there? Or are you saying that the rational thing to do is just wait for the hard data to show what's really actually happening?
I think in part. I guess that especially when we look at sort of public markets, to me that there are real sort of opportunities hidden in plain sight in terms of where investors should be allocating and sort of spending their time. And one of the key sort of lenses that we're sort of suggesting that investors look through is a lens of valuation. So over much of the last sort of 10 or 15 years. For many investors, valuation has been something of a false friend. Markets or stocks that were expensive became more expensive, and things that were cheap, that cheap became a euphemism for failing. But actually, I think looking at the markets ahead of us, I think that valuation becomes a deeper predictor of future returns. So therefore, I think that rather than trying to just simply focus on whether, short-term economic direction is going to go positively or negatively at the margin, I think this is a time for investors, across the board to take a step back and say, right, where do we want to be for the next handful of years rather than the next sort of, couple of quarters.
OK, so you focus on the individual companies themselves. But
no, even at the market level as well, right? So you have many public equity markets around the world that are trading lower than their kind of long-term valuations. The UK would be a good example, Europe, Japan, China.
Yeah, I wonder specifically on European equities and how you feed in the euro story. Some pockets of the market much more exposed to the euro strength and the difficulties ahead and potential furthermore earnings downgrades because of that. How are you thinking about that?
So you're right that there are elements of the dollar strength and the euro strength in the short term which might be a headwind on export-orientated sectors. That being said, I think we're at the foothills of seeing quite a major shift in sort of economic strategy and economic policy within Europe, which I think could be very stimulative for domestic demand. Don't forget that Europe, and again, the received wisdom about Europe is it's a very stagnant economy. It doesn't grow. They've been very sort of fiscally conservative, especially economies like Europe. So, what we might be starting to see is an economic strategy which in some ways is a response to what's happening in the US, and that could actually be quite positive for domestic demand.
Beyond defence, beyond infrastructure, you see that?
Yes, even, the one thing that people struggle to get excited about, or very rarely get excited about, is consumption in Europe. But you could actually have an environment where domestic demand, consumption could end up becoming surprising positively on the upside. You could look at areas like financial bank stocks in Europe, again, looking very undervalued and have done for, or very lowly valued and have done for a long period of time. So again, those are areas which could be sources of future returns.
But so much of that potential source of future return kind of lays, and you use the financials example, but I could extend it to the oil sector as well, lays in the hands of buybacks. The minute you have or showing or that you are consistently providing those capital returns to shareholders, you have the shareholders there to buy the stock and demand it. That is a real U-turn from what we've seen historically in Europe until the last couple of years in financials, in some of the energy space as well. Several other sectors are a part of that. But what happens when you start to see buyback suspensions? Is that in the cards?
Well, I think there's a part of what you're seeing with respect to buybacks, which is that for many of those companies, again, come back to this sort of principle of valuation and source of returns. They're seeing it as a very efficient source of capital allocation. If they're trying to get the highest returns on capital, actually buying back their own equity is one significant source of that. You might start to see, though, as, the sort of the real operating sort of conditions start to improve, that they might take other decisions. But again, I would say that what I see today in the phenomenon around buybacks is just underpinning their view of the value in the equity.
Just walk us through the connection between the equity market and the bond market here, because if you're talking about the strength in European corporates, wouldn't that be matched by extra issuance, extra fundraising in the debt markets? There's no evidence of that just yet.
Well, I think, again, when you start to sort of take a step back and look at public markets and think where we are, we're entering this phase. What's really unusual about it is you're entering this phase where, parts of governments, the government sector globally has a high degree of leverage. But if you look at households in many parts of the world, you look at the corporate sectors, actually the balance sheets are almost, they're very, very strong. So there's a long way to go, really, until you start to kind of see that sort of pressure.
As you look at the allocation around the value story, what do you do in that environment then? Where does tech fit in that as the growth segment that has led to that shift that you illustrated, that you think is now changing, that value has struggled because growth has appealed despite the rich valuations? Where do you put tech in that new narrative that you see?
Yeah, I think a lot of the companies within the technology sector have to be reassessed, because I think part of the valuation they recorded is because they were perceived as representing an opportunity for growth in a global economy where there was an absence of growth. But actually, if you have other sources of growth in the economy driven by infrastructure spending, driven by better consumer demand, then I think what you're going to get inevitably, Tom, is a sort of a rebalancing in terms of where people start to see opportunities for kind of future returns. Doesn't mean to say that every single, technology stock in the market doesn't offer the prospect for attractive returns. But again, a bit similar to what we're talking about in terms of regional allocations, we're just talking about a rebalancing.
All right. Paras Anand, Chief Investment Officer over at Artemis, joining us around the table this morning on how he views these markets. We thank you so much. Let's do a quick check on the core six, the major heavyweights in Europe that, of course, moved this market up and down. Remember, light volume, light liquidity. Nevertheless, Novo Nordisk is soaring, I should say. Shares are soaring, higher by 1.2% this morning. It's coming after the FDA approval of the oral product of their Wegovy drug, getting that early sign-off from the U.S. government. LVMH also higher by 0.1%. Nestle higher by 0.3% as well. So in terms of the kind of consumer-driven bid, seeing some green on screen. Schneider Electric not doing a whole lot. ASML, I feel like higher by 0.2%, but in this macroeconomic environment, that is basically a nothing move. And Ferrari taking a relative beating, down by 0.5%. I wonder how much of the Stellantis story is bleeding into that one, Lizzy.
Not huge moves, therefore, on the core six, Kriti, but Shell is one stock that is moving a lot this morning in Amsterdam, down 2.9%. We're going to dive into that, as well as the other stocks that are making big moves at the open. Shell taking that interest in BP as its rival struggles to turn around its fortunes. Stocks to watch next. The movers. This is Bloomberg.
Welcome back to the opening trade. We are 16 minutes into today's session. European markets are currently just off by about 0.1% after a strong run. 9 straight days of gains. The UK closed, of course, for a bank holiday. The US futures picture looking down after 9 straight days of gains there as well. S&P futures down by 0.7%. Nasdaq 100 futures in similar territory. Let's check in on some of the individual stocks on the move. Kriti, starting with Novo.
Yeah, higher by 1.1%. We've traditionally, when we talk about Novo, at least in the last couple of weeks, and I'd argue say months, it tends to be a downside story. Today is the exception, even amid a backdrop of low volume and low liquidity as well. This comes after the FDA accepts the application for the oral version of its blockbuster GLP-1 drug Wegovy for the treatment of chronic weight management. And this is really important here because we have seen the FDA actually pull back on some of these approvals or even the acceptance of applications as well. So this is a positive sign for Novo Nordisk, and the market's certainly treating it that way.
And the market's rewarding Erste Group as well in terms of their decision to buy a 49% stake in the Polish unit of Santander. So Santander's Polish business, which is listed as well, and that stock is down, but it's Erste which is benefiting in terms of the upside coming through, rewarding them in terms of investors for making that decision around buying that 49% stake in Santander's Polish unit for about 6.8, close to 7 billion euros. Interestingly, Santander says it will be able to potentially increase returns to shareholders above their 10 billion euro target on the back of this deal. So a big deal in the banking space this morning.
Yeah, speaking of M&A, potentially could be some in the energy space. So our scoop over the weekend that Shell is looking at buying BP. Shell, of course, has been more frugal than its British rival in recent times, but also BP struggling from its own net zero strategy, and it all coming to a head now with the lower oil price. So we're under $60 a barrel this morning on Brent, down 2.2%, and Shell shares in Amsterdam down 2.5%. So really getting hammered, and energy at the bottom of the sectoral basket across Europe down 1.3%. Shell saying that, well, we understand that Shell is watching BP's share price for when it gets to that point, that it really should swoop in. But let's get more details now on that story. We have our energy markets reporter, Anthony Di Paola, joining us now. Anthony, really good to have you. I wonder, there's been speculation about a Shell BP deal for years and years now. Obviously, it's more pronounced at this point because of BP's woes. But what do you think is going to be the threshold that would make Shell swoop on BP?
Yeah, good morning, Lizzy. It is an interesting story that has been developing, as you said, for a number of years. I mean, BP has been seen as weak even since the Deepwater Horizon disaster, which forced them to spend so much money on reparations there, and that those problems have only increased as investors have really undervalued those shares because of the push into new energies, say renewables or low carbon, and away from oil and gas. Now, the company's trying to move back in that oil and gas direction, but so far for investors, it's been too little, too late. What might get Shell to finally get over the hump and make that move would be perhaps if the shares go even lower for BP, or if they see a chance to get in there. We are now in a period of falling oil prices, as you were alluding to before, so that's also going to be hurting prices in the industry, so that might be an option. Shell has been doing some buybacks, so they've got some shares that they could use. So there is an opportunity that they're seeing here, and they're looking at that. And, you know, it's probably something that a lot of people across the industry are looking at, either the whole company or simple assets. So, of course, BP is a big company, and one of the reasons that Shell's always been rumored as one of the companies to take it over is because it's got the size and it's got the breadth to be able to take over a challenge like BP. So it's certainly going to be an interesting space to watch, but they'll need a little bit more to get them to that point where they're ready to go for the deal.
Well, they're certainly taking on a massive project, and I think something that both of these firms have been largely aligned in has been their kind of gas trading unit. Shell has really shown up in a big way when it comes to trading LNG and then, of course, providing LNG. What does this do, then, to BP's presence in that space?
Yeah, well, one of the things that we reported in that story over the weekend about Shell is that it would get them some more positioning in the U.S., they would be able to take some of the BP assets there. You know, where I'm sitting now in the Middle East, Shell has also sold out of a lot of its upstream, particularly in Abu Dhabi. So if they were to take over BP and those assets, that would give them a big presence here in terms of upstream production in Abu Dhabi, in the United Arab Emirates, as well as a big position in Iraq. In terms of gas, yeah, I mean, gas trading is a big part of it. BP's into a lot of those projects there. They also have a huge trading arm in general, so that would be a good bolt-on asset for Shell, which also has a trading arm. So to get in and combine those assets, LNG trading is a growing and a burgeoning area of the market. So we're seeing so many players getting in there now, particularly with the U.S. LNG export terminals coming on. So a lot of people are getting in and getting those supply contracts and looking towards the end of the decade and into the 2030s when there's going to be huge demand for that in power globally, and they see that really as a global market. So it's definitely an area that a lot of the oil companies, oil majors and national oil companies are looking at alike.
Anthony, do we know how Shell might look to fund this deal? And with the CMA, would regulators look favourably on a tie-up of this size and magnitude?
Yeah, well, you got to expect that they're going to use a lot of shares for a deal like this. I mentioned earlier that with the oil price going down, that's generally going to hurt oil major stocks. So that gives an opportunity to go in for a company like BP. But again, if you're trying to pay for it in stock, that also debases the value of what you would be using to pay for that deal. But you'd have to expect there's going to be a lot of shares used. It'll be a share offer. And again, oil companies in general have been buying back shares in this market, so that should give them some firepower. And of course, regulatory issues would have to be looked at, not only in the UK. Of course, that's going to be a concentration because the two companies are from there, but in many of these jurisdictions where they do have overlapping assets. So, of course, they're going to have to be looking at that carefully. And then that, of course, opens up a whole other M&A story if they have to offload assets after a deal, and other companies could come in and pick and choose. So really lots of issues still to watch in terms of that.
Excellent context on that Bloomberg scoop around Shell and BP. Bloomberg's Anthony DiPaola, thank you.
Speaking of consolidation on this side of the Atlantic, let's talk about someone who hasn't been a stranger to that when it comes to the States. Warren Buffett announcing that he intends to step down as CEO of Berkshire Hathaway at year-end, handing the reins to energy executive Greg Abel. Charlie Wells all over that story. Greg Abel, been with the company for a while, been a protege of Warren Buffett. Can anyone really step into those shoes, though?
Kriti, I was told early in my career, pick your predecessor wisely. And Greg Abel has not done that because he is in the sort of impossible position of having to follow Warren Buffett, clearly one of the most famous investors of all time. That return on Berkshire Hathaway of 5.5 million% between 1964 and 2024, that is a really difficult act to follow. And I think something about Buffett, too, is he made this really simple but difficult strategy of, buying and holding, looking for these excellent companies. He made that exciting for people. It's sort of a boring strategy, but he was able to make it exciting. He was able to basically get into the minds of that everyday investor, so they flock to Omaha every year, 40,000 people. Can Abel do that? I think that's going to be a huge challenge.
But from his background, what do we know about how differently he would actually run Berkshire Hathaway to Warren Buffett? What do we know about how much influence Buffett would still maintain?
This is a really good question. And, we know Buffett is great at picking stocks. He's clearly good at picking people, too. And there's a reason he backed Abel. And I think a lot of that has to do with the fact that he is very much an operations guy. He's someone who came up through the energy side of this business. He really has a knack for kind of getting into the nitty-gritty in a way that Buffett didn't necessarily. And so there's that. There's the element of picking deals. That's something that Abel is also really well known for, kind of selecting these deals. And that might indicate where Berkshire heads going forward.
Charlie, talk to us about some of the challenges for Abel and for Berkshire Hathaway that are sitting on this incredible cash pile.
Yeah, so look, they are sitting on this record $350 billion pile of cash. It's enormous. Investors now are asking, how are you going to allocate that? And how is that allocation going to be different for Abel than it was for Buffett? You also just have the fact that Berkshire Hathaway is an older company now, right? They've been kind of pivoting away from kind of wealth creation and more towards wealth maintenance. And so how does he do that? The number of employees is now about 400,000. They span so many industries, from rail to chocolate to furniture manufacturing. I think there's some questions, do these become acquisition targets for others? And so can Abel keep it all together? He has so much he's got to do with this huge company. He picked a difficult person to follow.
Yeah, from Gecko to Sears Candy. Charlie Wells, thank you very much indeed. Breaking down, of course, the change at the top of Berkshire Hathaway, at least by the end of this year. Warren Buffett stepping down, of course. Coming up, private markets going mainstream. Stepstone's bought long. Just this is what is unfolding within that space. That's coming up. This is Bloomberg.
This is the opening trade. We're 30 minutes into today's session, and across the Stock 600, it's flat to the downside. But don't forget, we're having a bank holiday here in the UK, so the FTSE's not trading. You've got the DAX up 0.25% and the CAC 40 in Paris down 0.4%. But as we pointed out earlier, lots of ex-dividend names this morning, not least Danone, Kering, Orange, Hermès. So that weighing on the CAC 40 this morning, perhaps. That's what's happening in your public markets, Kriti.
Absolutely. Let's talk about the private markets. Asset managers rushing to develop more private market offerings for a wider audience. Morgan Stanley, Goldman Sachs, both recently launching funds for investors wielding several $1 million. In his annual letter to shareholders, to investors, I should say, BlackRock's Larry Fink pledged to go even further with ambitions to democratize the access, something he's been saying for quite some time. It comes, of course, as the sector faces a lot of what the headlines say. Headwinds from trade tariff uncertainty to a lengthy slowdown in deal making, just as we thought there was a light at the end of the tunnel. Bob Long, CEO of Stepstone Private Wealth, part of Stepstone Group, which has about $179 billion of assets under management, joins us around the table. Now, I'm not going to ask you what the big man in the White House thinks.
I'm glad, since I actually don't know.
I mean, a favor to us all, perhaps. But I am curious about where the uncertainty actually lies, because I feel like I talk to investors like yourself or private market investors. They're looking at the volatility, and no one's actively pulling out of the private markets just yet. That freak out moment you're seeing in the public markets hasn't quite hit the private ones, despite the private markets moving at a lag to the public ones. So is that the inevitable? Is that where we're headed?
So a couple of things in what you said. First of all, the lesson of the great financial crisis was those who panicked and sold their private assets were hurt, including well-known institutions in the U.S., large pension plans, Ivy League endowments. So investors have learned panic selling at the beginning of crisis is not necessarily the right thing to do. What we see is individual investors leaning into the private markets because they see the benefits. They've learned the benefits of diversification and actually the growth drivers of private equity. The reason people invest in private equity, to quote the famous bank robber Willie Sutton, who said, why do I rob banks? Because that's where the money is. That's where the growth is.
Yeah.
Private companies are growing so much more quickly than the public markets or public companies. And so investors have rotated to private markets for that reason.
Talk to us a little bit about the supply of assets in the private markets here, because we've been eyeing these private markets have kind of a bit of a deal glut here. This was supposed to be, again, the year that everyone's supposed to kind of IPO and debut, and that hasn't happened yet because of the volatility. At the same time, you have a lot of, you mentioned the endowments, releasing some of their stakes into this market as well, some of their assets into this market. To what extent do we have too much supply? This is a long pause.
All right, so several things in what you said. The secondary market in private equity assets has increased or grown dramatically since the great financial crisis. And that in many ways is a good thing because it allows investors to rebalance their portfolio and overcome the so-called denominator effect, where their public market assets have shrunk and they seek to maintain a certain percentage or ratio from public markets to private market assets. So they sell into the private markets. And that creates opportunities on the secondary market to buy assets typically at discounts, meaningful discounts to current value. So that's where the activity today is. And in fact, those markets tend to operate on a quarterly basis. The transactions that tend generally act on quarter end or close on quarter end. And so you'll see more of that on the June and September quarter, rebalancing of assets.
Is there more discounting to go? And if so, which parts of the private equity space?
Yes, discounts will widen if the current dislocation continues in the public markets. And it will, private markets, so private equity, private credit, private real estate, private infrastructure. You'll see the greatest discounts in private equity. And so those discounts, the signaling of that, at least the price talk around that, has already started to widen. Historical discounts average about 20% in the private equity market. We've achieved about that at Stepstone over a 20 or 30 year. But importantly, buying at discounts is not where the value driver is. So you don't want to just buy a weak asset at a discount. You want to buy a good asset at a discount. And what we've seen is if you follow that strategy, the majority of your returns, 70% or so of your returns in our case, can come from appreciation from where you bought the asset. So the opportunity is to buy high-quality assets when others need liquidity and you have it.
What does infrastructure do in a slower growth environment with rates still at relatively high levels?
Really good question. And so infrastructure, at least in the U.S., private infrastructure is a relatively new asset class. It's a newer concept for us for private investors to own essential services. So let's first make sure we define infrastructure. So it's generally essential services with a competitive moat. Think about a toll road or an airport. They typically have inflation escalators built into their underlying contracts. So every quarter, if the consumer price index goes up, your toll goes up on the toll road. They benefit from long-term cash flows, and infrastructure assets are about as uncorrelated to other institutional caliber assets as anything you can own. So those assets tend to be more stable. Therefore, discounts in the secondary market tend to be single-digit discounts. And in fact, in 2022, we were able to buy assets, infrastructure secondaries, at low double-digit discounts, and so we leaned into those. In fact, we were overweight those in our core private markets fund because that opportunity presented itself. But it's not like venture capital where you might see a 30 or 40% discount to current value.
We don't have many toll roads in the UK. I'd love to own a toll road, wouldn't you? I mean, just like, that's just clicking in, just turning over. The pound goes in, the pound goes. Motorists won't be happy.
I've been complaining about it this weekend. I was on the M6 toll this weekend, and it's
there you go, there's the complaint. We'd be cashing in,
us dry. No, look, Bob, really good to have you. I mean, you've been talking about how, this growth of private markets isn't anything new. Right. Actually, the democratisation story is we're past that. You've said previously.
I have. I believe we're in the institutionalization of democratization. Simple access is old news. What you see today, this is a really important point, individual investors get access to the same deals at the same price at the same time as the institutional investors. Individuals access the same time, same price as institutions. And that flattening, that transparency is really what's changed over the last 10 years.
So you're going mainstream. Doesn't that
Yes.
invite more regulatory scrutiny for your industry?
It does, and that's a great point. And so we interact regularly with the regulators, of course. Our funds in the U.S. are SEC registered under the 40 Act and the 33 Act, which means they are just as regulated as a U.S. mutual fund and a U.S. publicly traded company. So that regulation, while having a couple of basis points of cost to investors, we believe is well worth it in terms of the assurances, governance, and discipline that it provides.
And then do you expect more consolidation as the sector kind of evolves?
I do. You have seen a number of smaller players get into this evergreen fund business, which is another way of calling what we do. And what you find is to feed an evergreen fund, because you have unpredictable inflows, and then, of course, your cash flows are somewhat unpredictable. We just talked about a weakening exit environment. Scale of a firm like StepStone, being one of, if not the largest allocators to the private markets globally, $70 billion a year that we close, not that we look at. We close $70 billion a year, 550 separate transactions. The ability to look at that amount of flow to feed evergreen funds is really important. And in my opinion, those who don't have the flow will struggle to run an evergreen fund during a period of dislocation.
What's the opportunity when it comes to venture capital? We're looking at timeframes now that have gone from 7 to 8 years to what, kind of 12, 13, 14, 15. The liquidity squeeze and the liquidity challenge is there, which is opening up an opportunity for secondaries. Do you play a role there?
We do. We are a very active buyer. I believe we are the largest buyer in the secondary market of both fund interest and individual company interest. But this is a great example of how capital markets and legal structures have evolved. So I've been the CEO of a public company twice. It's for the birds, by the way. Those companies have learned that you don't have to go public. But, of course, one reason to go public was to give your early employees, whose net worth is all in the stock of your private company, take a SpaceX, for example. So the private markets have developed a method whereby the individual employees or even really early investors can gain liquidity, generally through auctions run by the company. SpaceX runs a regular auction. We're an approved buyer, where we have the ability to buy shares at a price they set. And, of course, they're controlling who comes in. Further disintermediation of the public markets.
How much SpaceX do you own?
I can't quote that exact number, but it is a substantial position in Spring, our evergreen venture fund.
Do you own other kind of space-related, defense-related assets?
We do, and in fact, defense tech is, on a relative basis, a meaningful allocation in Spring, our evergreen venture capital and growth equity fund. We believe that defense tech benefits from a secular trend. Companies like Saronic and Anduril are really growth drivers still within the industrial space, right?
Yeah.
The manufacturing space. We believe they are growth drivers, and we've leaned into that subsector.
So much of that area, though, comes from, and historically has come from defense contracts, though. It has come from the likes of the federal government. And yet you are seeing this government under Donald Trump actually pull back on some of those defense contracts as well, not just to the space players, but to the likes of Lockheed Martin, for example, or Boeing as well. Where does the growth potential come from without that federal backstop?
First, it comes from other countries. So these defense contractors work with friendly countries all around the world. And secondly, their business models are different. Rather than the legacy large primes, they're called, who will bid to the United States government with a PowerPoint get a cost-plus contract that then, they're typically over budget and behind time. These venture-backed companies will figure out what the government wants and build it and then sell it at a price that makes sense. These companies are growing, the ones I mentioned, extremely quickly because, unfortunately, we live in a much more dangerous world today.
Yeah, Anduril is very prominent in that space. When it comes to Europe, are you finding names in Europe, companies like Helsing and others? Are you looking to add within defence tech?
We do. We've looked hard at those. I can't name specific things that we've purchased or things that we're looking at purchasing, but it's clearly a global industry from Europe to Israel, even to Japan and Korea, where we can invest in very fast-growing companies with game-changing technologies that we believe will be the next really high-growth companies.
And SpaceX IPOs when?
I don't know the answer to that, but let me change the tone on that. So, what could be more capital-intensive than building rocket ships? When I came along to grow an enterprise of that size and scale, when I was a young man, you had to go public. There wasn't enough capital in the private markets to build something like a SpaceX. But today, you see very large enterprises that can stay private longer because they believe it benefits them.
But you're not seeing that element in Europe. This still feels like a relatively U.S.-centric concept.
Not an expert on that, but that makes sense to me.
That it is a U.S.-centric concept. Talk to us a little bit about other investors like yourself. How did you even come across SpaceX as a key investment for you?
Sure. So we have one of, if not the largest teams dedicated to venture capital and growth equity in the world. There are over 70 investment professionals in our firm who just do that. And in fact, we actually invest $6 to $8 billion a year in that industry, in venture capital and growth equity on a global basis. So we are actively in dialogue with the largest and best venture capital and growth equity firms, talking to them about their best companies, meeting their management teams, which positions us to then support them by buying shares in the secondary market or even leading rounds when those companies in their later stages need additional capital.
Okay. Rob Long with the long view on these markets. CEO of Stepstone Private Wealth, we thank you. It is fascinating to have you around the table this morning. And coming up on the programme, oil tumbles after OPEC Plus announces a bumper supply boost. We're going to look at the implications of that next. This is Bloomberg.
Welcome back to the opening trade. We are 47 minutes into today's session. European stocks are currently flat. The UK closed for a bank holiday. 9 straight days of gains for European equities. Up until this point, I should say, flat right now. We'll see how that evolves, of course, through the session. To the oil story right now, energy oil slumping on concerns of a global glut after OPEC Plus agreed to boost output by over 400,000 barrels a day from next month. Bloomberg's Asia Energy team leader, Stephen Strapczynski, joins us now with the details. What is underpinning then, Stephen, the decision for OPEC Plus's new increase in a moment and a time of weaker oil prices?
I mean, this really seems to be a strategy to sort of emphasize that you have to hit your commitments. This seems particularly targeted at those who weren't hitting their quotas, which is Iraq and Kazakhstan. They're putting pressure on them to hit their numbers and not produce more than they agreed upon. That is the the view within the OPEC Plus bubble at the moment. It's a big shift in strategy where OPEC Plus and Saudi Arabia have been trying to defend prices for the better part of a decade instead of adding oil into an already weak market. You could also see this targeted potentially at U.S. oil drillers. Shale producers have consistently increased production over the last decade as OPEC Plus has kind of curbed their output to help to kind of put some upward pressure on prices. And if they were to continue adding oil into the market, we're starting to see levels where potentially, we're going to see oil rigs being closed. You're getting already below the break-even level for a lot of U.S. oil drillers in many of the shale plays. At the same time, you're also, you're not quite there yet for shut-ins, but you're at a level where, when you're talking about capital discipline, especially within U.S. shale drilling companies, they might start saying, hey, we need to kind of reduce our output to help, maintain where we are because we're not making as much money We're not profitable at these current levels. So to put into conclusion, to summarize this, it's really, Saudi Arabia and OPEC, other OPEC plus leaders looking to sweat the market and see where we go to. It's quite reminiscent to where we were in 2014 when they allowed oil to flow quite rigorously, adding pressure to shale producers. They're doing it again this time around.
But Stephen, Riyadh may say that it can weather these lower prices. Can the other OPEC plus members? How fragile does it leave the OPEC alliance?
Well, I mean, that's, I think, the big question. And that's what we heard from Saudi Arabia's oil minister just over the weekend. They need to have this coordinated push. He harkened back to the 1973 oil embargo when the team members joined together to punish the West over supporting Israel in the Yom Kippur War. It's the same sort of thing where it's the opposite. They're adding oil to the market, but they need to be coordinated and sticking together. And sticking together means that they need to hit their quotas. And so the big question is, will Iraq and Kazakhstan, will they break? Will they decide to reduce their output to where they're supposed to be? That's sort of the big question and how they're going to move forward. Now, famously, you've seen what economists have said about the break-even levels for the budget for Saudi Arabia and others. They want oil Brent levels to be closer to the $80, $90 level for all of their ambitious sort of post-oil investments and strategies. That's where they're balanced, where their budget is balanced the best. And so you are going to see some near-term pain. But clearly, Saudi Arabia and the others who support this plan are not looking at the near-term view. They're looking at a unity, and they're also looking at potentially getting market share back away from U.S. shale drillers.
Stephen, a final question to you away from the oil story, and that is just a headline we've gotten in the last hour or so, that Europe is reportedly set to ban Russian gas imports by 2027. Walk us through what we know on that front.
Yeah, this is something that they've been discussing for a long time. How does the European Union reduce their dependence on Russian gas? Now, you might say, hey, Steve, they've been reducing imports of Russian pipeline gas pretty significantly over the last 3 years since the Ukraine war began in 2022. But you would be forgetting that the European Union imports still quite a bit of gas in the form of LNG from Russia. Russian LNG imports have hit a record high, and this is likely the target in this case. Now, LNG contracts are difficult to cancel. There are parts of the contracts that have take or pay clauses, which mean if you don't take the LNG, you still have to pay the Russian supplier. If the European Union were to ban this, then potentially this would be a way for European countries to exit legally the contracts that they have in place, maybe putting forward a force majeure or other sort of clauses to help them reduce these long-term contracts. Now, these Russian contracts are for decades, so this is something that's been difficult for the importers to kind of get around. Despite the war ongoing, LNG imports into the EU has increased, and reducing this will be a major talking point. Now, I do want to say that this ban for the end of 2027 is still just a proposal. It does depend on whether or not the European Union is able to find alternative sources of LNG away from Russia and from potentially the United States, Qatar, or others.
Okay. European gas futures down off the back of that. Stephen Sapczynski, our Asia Energy Team Leader, we thank you. Also looking at Brent lower than $60 a barrel as things stand, down 2.1% off the back of that OPEC Plus meeting. And maybe that means lower inflation and maybe less reason for the Fed to cut rates. Certainly what one man thinks. President Trump insisting as well, though, that he doesn't plan to fire Jerome Powell. In an interview with NBC's Meet the Press, Trump said that he is not going to remove the Fed chair.
He should lower them, and at some point he will. He'd rather not, because he's not a fan of mine. He just doesn't like me because I think he's a total stiff. And, it's just one of those things. He should lower them. And I wish the people that are on that board would get him to lower, because we are at a perfect time. It's already late, but he should lower interest rates.
Donald Trump there. Let's bring in Bloomberg's Valerie Titel for a look ahead to what we've got on the docket this week. Of course, that Fed decision on Wednesday, Val. I wonder, really what the focus will be, because markets and economists expecting a hold.
Yeah, that's right, Lizzie. It is going to be a lot about the messaging in the press conference. The Fed is widely expected to go on hold. But I will say that the bond market, at least, has really swung to pricing in what Powell wants rather than what Trump wants, which is an immediate Fed cut. The bond market in the last 2 sessions, take a look at the move in 2-year yields. It's risen over 20 basis points. The Thursday and Friday move combined, biggest 2-day move for the 2-year yield in over 6 months, as we continue to price out the expectations for when the next Fed cut will come. Economists are also changing their mind. We have the likes of Goldman and Barclays as well. Originally, they were calling for a June cut at the Fed's next meeting. That's been shoved out as well to the July meeting. Now, all this, the catalyst was that hot payroll print on Friday. A lot of economists and market participants out there think that the Fed does need a rise in the unemployment rate in order to justify messaging that a rate cut is on the cards. And after Friday's hot print, we haven't seen the unemployment rate tick up. Little urgency for the Fed to react on the back of that. So it might be just a big repeat of his last press conference when he essentially said there's so much uncertainty we can't forecast, we're on hold.
Part of that uncertainty comes down to the trade deals that are in the works, and Trump is suggesting that maybe you get some deals this week. What a deal looks like, whether it's an MOU, whether it's something more detailed. How sensitive are the markets to what specifically is the makeup of a deal, or is a headline on some kind of agreement enough to keep the momentum going?
Yeah, well, I think the market might maybe run to many conclusions on the first trade deal. They might assume that whatever the blueprint is for the first trade deal might come with the others. And the speculation over the weekend after seeing this big move in the Taiwanese dollar is that perhaps FX is really on the cards in these trade deals. Why else would the Taiwanese central bank allow their currency to strengthen near 7% in 2 sessions? It really is leading some to believe that perhaps a weaker dollar policy from these trade negotiations is perhaps what the Trump administration is after.
OK, Valerie Teitel, our markets reporter, of course, in terms of how to think about the trade deals, the impact on the markets, and then leading up to the Fed decision. Briefly touching in on the earnings calendar for you this week, because there's another big week of earnings with a build-up all the way up to Thursday. Things kicking off tomorrow, of course, on Thursday on the consumer space. AB InBev, that's going to be really interesting. And there's some defence companies, banks as well, in focus for us with Commerzbank on Friday. Kriti.
Absolutely. Looking forward to that in a program. We know Bloomberg TV and radio are live from the Milken Conference in L.A. this week, speaking with the biggest names in business. Don't miss that coverage. That does it for the opening trade. The Pulse is up next. This is Bloomberg.